There's anything that goes up must surely come down. Recession is not just a new thing, it's something that has always been, and it's a natural economic cycle. So even if we have a recession, hopefully it's going to go away within 6 to 18 months. Recession tries to favor multifamily as well as inflation. Hello everyone, if you're just joining us for the first time, welcome to Ask the Multifamily Expert. And today we'll be discussing a very interesting topic. And the reason why I decided to talk about this topic is because as an asset manager, what we normally do is to see what the macroeconomy is doing, and we always look for ways to see how we can mitigate them. And not just that, we also like to bring it up to people so that people can start adjusting or pivoting if they have to. As much as possible, we'll be bringing you a lot of information on what is going on in the market. So all you need to do is to continuously stay tuned to our events. And if you're not joining us on our social media platform, because that is also a platform where we also discuss this kind of issues, always discuss what is trending in the market. I always discuss issues that might happen, and as an investor, how you can mitigate them. So this is how you can connect with us on our social media platform. Bibi Ofiri on YouTube is BIBI Ofiri. On LinkedIn is simply Bibi Ofiri, and on Instagram is BlueOcean_MF Group. Although I have my personal Instagram page, which is also Bibi_Ofiri, and on Facebook it is official Bibi Ofiri. And we also have a group on Facebook which is Blue Ocean Multifamily Group, a private group where we also give out content and all that. So if you're not joining, I think you're missing a lot. Every day we put out good stuff, and I mean it, good stuff. So we're going to dive right into what we have for today. Today's topic is multifamily, a recession proof, and how we can kind of mitigate it during downtime. And the reason why we are discussing this, I'm going to give us a background to why we decided to pick this conversation. So I've been following the news, and recently 60% of the US CEOs are predicting that there will be recession very soon in the next 6 months. Will that happen? We don't know, but are the indicators there? Yes, they're all out there. So that is why we are discussing it, because it's becoming more like a threat. I'm going to walk us through the historical trend of recession, because recession is not just a new thing, it's something that has always been, and it's a natural economic cycle. So I don't want us to get all freaked out and all that. It's natural. The economic cycle is like this. So I'm going to walk us through what that looks like, and I'm also going to walk us through the historical trend, and I'm also going to walk us through how multifamily was able to prove that it's a recession resilient, and what investors like us can do. Then I'll open up the floor for Q&A, or if you don't have Q&A, I already have Q&A that I'm going to answer, and I'm sure that most of them would maybe answer your question. So let's dive right into it. So first of all, what is recession? According to what they say, 2 consecutive quarters of a negative GDP. But is it that straightforward? Because we've been hearing this for the last 2 years, that either America is in recession or about to be in recession for the last 2 years. Not just in this administration, it's been up there for a while now. But what are the indicators of recession? But before we go right into that, let's talk about the economic cycle. Why recession is part of the economic cycle. So it's normal. There's nothing wrong with it. But the idea is, how does it happen? So recession most times occur between 7 to 10 years in an economic cycle. But the difference between this one, I don't know if you all agree with me, it looks like it's man-made because of policy. So I would like to say here that we don't discuss politics here, but there's no way we can talk about the macroeconomy without talking about the fiscal policies or policies that affect the economy. It's not possible. We are not politicians here, but want to address issues that affect us as people that stay in the US. The economic cycle, we have the expansion stage. This is where the GDP increases, businesses grow, and investments grow. Consumer spending is high, unemployment decreases, stock market often performs well. We saw that happening not too long ago. We saw that GDP was growing a few years back. Inflation began to rise. And this was just before the inflation inflation started. This was somewhere around 2021 to 2022 before the inflation peaked. That was an expansion. We saw growth in GDP. People were spending. A lot of money was in the economy. The next one is the peak. There's anything that goes up must surely come down. So when the economy keeps going up, it will get to its peak and it will break. That point at which it gets to its peak is called the peak point. It is the economy's growth when it has reached its highest point. We have full employment or labor. Remember 3 years ago, we saw employees telling employers the kind of salary that they wanted. And we saw employers switching jobs like they were switching their clothes. That was because it was an employee's market. And that was when the economy was at its peak. If you study the macroeconomy or the economic cycle, you will always be prepared to know when something is about to bust. So at periods like that, if you are very sensitive, you should know that there will soon be a decline. So we had full employment or labor shortages. We had more jobs than people to do it. We had inflation maybe at its highest in 2022 in July or June. Inflation was at 9.2%, the highest in recent time. Interest rates will also go high. We saw that the Fed started increasing interest rates from 2022 to 2024 because of inflation. Signals of potential turning point. So we started seeing a lot of fears. People were very scared in the economy at that point. The next cycle in the economic cycle is called the contraction. That is the recession. So if you look at it, it's like we are following the cycle. But the difference, like I said in this, is that this recession that's about to happen, we don't know if it's going to happen. What that might happen is actually man-made. And why do I say it's man-made? It's because of the policies like the tariff, unemployment, the cut on federal employment, and all that. All those things are things that are spiking it or pushing it to happen. Except if something is done, we don't think we'll be able to get away from this recession. Hopefully, the administration will do something about it. So right now, we are approaching, or if not in the recession, although economists said that we are not yet there, I'm also going to tell us some indicators. So you be the judge. You tell me if we're actually there or we are not there. The recession part is when the gross domestic income declines. That is, people stop to spend, less money in the economy, businesses' profits shrink. If there's a lot of tariffs on goods, businesses will start to shrink. That is automatic. And that is what might happen if this continues. Layoffs are rising. We saw that happening, a lot of layoffs in the market. We saw federal cuts just a few months back. Consumer spendings drop because people are scared. Some people are saying cash is king. So we're seeing consumers sitting down on cash and not spending as they normally would do. Stock markets may decline. I don't know how many of you heard the news that one luxury brand was selling to Prada, and that happened some few weeks ago. And the reason why they were selling was because they don't have so much customers like they normally do. That is, the spending power is coming down. People are no longer looking to buy luxury items, but rather the regular. So they experienced some decline in their sales. So they decided to sell off to Prada. So this is not just about them. It's about so many businesses that are going on in the economy. I'm not saying this to scare us, but the fact remains that we need to know so that we can easily pivot to what is good. The next thing is the stock markets may decline. We are saying it's happening right in front of us. Stock market decline. And stock market is more about perceptions. What people perceive the market to be, that is how it's going to work. So if people perceive a decline or uncertainty in the market, it's going to affect the stock market. So we are seeing that happen. So like I said, you be the judge. Lower investment activities. We are seeing foreign investors pausing on their investments. We have some Canadian friends, and some of them are not even visiting, not even talking of. There was one that wanted to partner with two of us on a JV deal, and he just called us a few days ago and said, I don't know what is happening in the US. I want to hold off. I want to see exactly how this whole thing will turn out. So we're seeing lower investment activities happening currently. The next one is the trough. The trough is the lowest point. That is the lowest point that is going to go back to expansion. At this point, unemployment stops rising. So it just stops. Economy stabilizes. At lower points of the cycle, the stage is set for recovery and new expansion. So this is the economic cycle. So please put this down. That's why I said that recession is part of the economic cycle. But we would have rather preferred it if we came on its own without policies or anybody trying to instigate it. So that is where it is. So I'm going to tell us how, because right now we don't even know if we're in one. But however, the National Bureau of Economy Research uses a broader range of indicators to know if we're in a recession. So one of them is employment rate. Employment rate, as at the last employment rate report, was about 4.2%, which is relatively okay. It hasn't gotten to that level yet. So 4.2% is high, but not that high to say that that will cause a recession. Consumer confidence. Yes, this one is literally happening. Consumers are not confident about the market currently. The next indicator is industrial production. Now, with the tariff going on, we don't know how that will play out. If some industries will shut down or to make industries grow, we don't know, because some people might decide to move in their business back to the US. Some might decide to just fold up entirely because the money to move down their business might just be too much for them to do that. So we're yet to see how that will play out with the industrial production. The next one is retail sales. That one is happening as we speak. Not just recently. In 2 years now, retail businesses have been nosediving, especially in San Francisco and some other locations. We are seeing businesses go down as it could be. So these are real life issues. Until they declare there's a recession, there is none. But with these indicators, it feels like we're already in one. So let's go right into the trend of how recession has been playing out for a very long time until date. The historical recession trend, like I said before, recession occurs every 7 to 10 years on average. So it's normal. What usually triggers it is inflation, interest rate hikes, and financial crisis, which we are currently in. Inflation just went down. As at January, it was about 4.5%. Right now, I think with the recent news, it was 2.4%. So inflation is good as at the last report. We don't know what that would look like going forward. Interest rate was going up for a while. All of a sudden, it started declining. But right now, I think in the last few days, it has gone up again. Financial crisis, it just depends on who you're talking to save when in any financial crisis. It tends to last between 6 to 18 months. So guys, please relax. Even if we have a recession, hopefully it's going to go away within 6 to 18 months. Although the one that happened during the pandemic went away in 2 months. So let's go through this. The first Great Depression or recession happened in 1929 to 1939. This was the deepest and longest in the US history. It happened for about 10 years. It triggered stock market crash. Unemployment peaked at 25%. So when I say that currently we are 4.1% unemployment, that is a good signal that we are not in recession, right? Compare that with 25% unemployment. I don't know what that is. Literally a quarter of the entire nation was unemployed. And for you to know that 1% of unemployment means that 1.67 million people were unemployed on the average. So anytime you see 1% of unemployment, it means about almost 1.7 million people are employed. Do 1.7 million people times 25%. That is crazy. So you don't want to know what that looked like in 1929. Post-World War II recession, 1945 to 1982. This was tied to inflation, oil shock, and war transition. So that was during the World War and all that. But it led to stagflation. The meaning of that is there was high inflation plus high employment at that time. In 1990s recession, 1990 to 1991, it was caused by monetary policies and Gulf War uncertainty. It was relatively short, but recovery was slow. It was a very short one. The next one is the dot-com. This is the one that most of us are familiar with because I think that's when some of us started becoming mature to understand what was happening in the economy. 2001. It was triggered by the tech bubble, brief recession softened by Fed rate cuts. Most of us experienced that. The one that most of us talk about is the recession that happened in 2007 to 2009. This was during the Obama period, and this came from Bush down to Obama. So this was triggered by housing market crash and financial crisis. This was when everybody could get a house, whether you qualified or not. And it was just a matter of time for everything to crash. And we saw that happening right there. Houses were crashing, foreclosures increased. People were walking away from their homes, dumping their keys and what, because the homes had no more value and they couldn't pay for it. And everything just nosedived. Deep global impact on employment hit 10%. When I say deep global impact, they say when the US sneezes, the whole world catches cold. That was what happened. It happened in the US, but the entire world faced the consequences. And this led to massive bailout and long recovery. It was a long recovery because so many people lost their houses. The one that is the most familiar and the most recent one was COVID-19 recession. And this was the sharpest, shortest on record. It happened just 5 years ago. And this was caused by the pandemic lockdown. How we came out of it was because of the stimulus. There was a lot of injection of money into the economy. This was how we're able to rebound. But people say that that injection into the economy increased our US debt. That is, there was a lot of money pumping into the economy, and that came from the Fed, and that increased our debt limit. That was the highest increase so far in our US debt. If you've not watched my video on the US national debt, I think you should go right to my YouTube page to see what that is all about. Right now, it's on a ticking bomb. We spend more than we get. There's a lot of deficit, and we are borrowing actually to pay off those deficits. And the more we borrow, the more the interest that we pay on it increases. So it's really, really massive. Last year, we spent almost 900 billion to service our debt. This year, it is projected that we'll spend about $1 trillion to service our debt. So these are significant numbers. Really, it was good in 2000, but during the recession, there was a lot of expenses, and that was due to the pandemic. It helped the country rebound, but at the same time, it created a lot of liabilities for the nation. Before we discuss the impact of that on the multifamily, we're going to discuss how multifamily was able to rebound, or did it even rebound during those recession periods I just mentioned. Let's dive right into it. Multifamily performance during recession. Why I believe multifamily is recession proof. In 1929 to 1939, the longest recession ever, we saw a widespread foreclosures. Then we didn't have a lot of institutions in the multifamily space, so multifamily was severely hit in 1929 to 1939. But come World War III, there was a mixed result. Inflation helped rents, but high interest rate hurt financing. So this was more about people that were buying. So it was really, really very impactful and hurtful to those people that were buying, but it helped multifamily. The next one is 1990 to 1991. It was mild impact, that is, overbuilt market suffered, but renters stayed in demand. That is, because of demand and supply, multifamily was able to strive during that time. During the dot-com bust in 2001, there was solid performance, renter demand stable, better than office and retail. We saw that happening for multifamily, and also this is also due to renter demand. Less people were buying houses and more people decided to jump into renter, and that was why the multifamily thrived. The next one is Great Recession, which was 2007 to 2009. This was a very strong performer. Foreclosures boosted renter demand. So while people were walking away from their houses, would they be staying under the bridge or be staying on the street? No, they went straight right in to start renting apartments, and that was why there was a strong performer during that time. And those class of property that performed very well were the B class and the C class. If you don't know the classes of multifamily, go to my YouTube page and watch the different classes of multifamily. We have the A, B, C, and D. You need to know the different classes. So the B and C class literally will strive during Great Recession, and those are the assets that we kind of buy. COVID-19 recession, this was resilient overall. There was struggle in the class A parts. For assets that were in class A, there was a lot of struggle, but come the B and C class, it really strived. Besides, they had the government support. There was a lot of stimulus checks going out to owners to pay for people that could not pay, and that was why it was very resilient. And again, don't forget, people were staying home. It was a lockdown, so people needed where to stay. People could not afford to stay on the road in their cars and all that. People were looking for homes to stay, so that was why it thrived. So in overall, recession tries to favor multifamily as well as inflation. So let's go right into the impact on recession on multifamily investment. So it's not all rosy as we think it is. And put down this, there's some impact on recession, both positive and negative ones. So like what I said, if you saw the trend, you see that recession kind of favors multifamily. And how does that happen? There's increase in renter demand. That is because people can no longer afford to get the American dream. One of the factors of American dream is you getting your home. But if the financing for getting your home is high, how would you get it? You rather go rent and wait and see if things will cool off. And that is why a multifamily, there's increased renter demand. Even in inflation period, we saw that happening and all that. I just showed it to you. But the issue, why is there is an increase in renter demand, we see a decline in rent. So for some of you that are in acquisition, underwriting deals, you need to be very careful at this point in time. And what do you need to do? If you have questions, please go right ahead and ask them. I will just be talking. These are topics that I enjoy discussing. So if you have questions, please go right ahead and ask them. But let me continue. Yes, there's a high demand for increased renter, but another thing is there's slower rent growth. So there's an increased renter, but there's slower rent growth happening, even if there's an increased demand. You see that rent tends to decline or does not even grow. So some of you that are underwriting deals and you are estimating that your rent escalation is going to be 10%, 50%, 100%, you need to be very careful right there, because if there's recession, yes, you're going to have the demand, but you might not be able to increase rent like you think you would. The next one is higher interest rates and financing costs. In the last few days, we've seen that interest rate is trying to go up again. Financing costs is becoming higher. So that is the issue with that. If there's recession, it's going to increase our interest rates and higher financing costs. And if interest rate goes up, it's just a matter matter of time. It's a ripple effect on cap rate. So I've explained before what cap rate is. Well, cap rate tends to be parallel with interest rate. When there's an increased interest rate, it increases cap rate. And once cap rate goes up, that means the value of a property goes down. So we'll be seeing valuation of properties going down, not as much as people will think that it will if there's recession. So it's going to affect the valuation of properties going forward. Then operational pressure and delinquencies. This is going to put a lot of pressure on people like us and on people like the property manager to perform. We'll have to be very, very strategic. We'll have to be very innovative. And it's no longer the period whereby you have a property and you remove your hands and say it's going to perform on its own. This is a time for rework. It's not 2000 or 2002 where people could literally buy a house and not even fix it and sell, and they will make a lot of profit. Now, multifamily are for those that are able to do the work. So if you're not able to do the work, then I'm sorry, you might see that your multifamily is failing. So it puts a lot of pressure on asset managers and the property managers managing the daily activities of that property. It has become more central that operation is not a major factor in multifamily. That's what I always tell people. Invest in people that know what they are doing. If you are not sure that these people know what they are doing, please don't, because this period is not going to show mercy on anyone. So it's about those that actually know exactly what they are doing. So I can tell you for a fact that Blue Ocean, we know what we are doing. We've gone through this over and over again. And besides that, even in everything that is happening, I can tell you for a fact that our investors are happy because we've been giving back-to-back distribution for the last 2 years. It's been back-to-back. We've not missed anyone. We've been giving investors that. If you're one of my investors, I'm sure you agree with me. This is very true and you can verify it. So you need to partner with people that know how to do the job. So what are the strategies as multifamily investors that we should start doing to ensure that we mitigate if there's recession? What can we start doing? The first thing for us to do is we should focus on cash flow stability. I cannot overemphasize this. As many of you that invest in IRAs, 401k, stock market, and you don't have multifamily as part of your portfolio, you're in for a great surprise because, like I said, the economy cycle is always going to happen. So if you think you are doing well now, it's only a matter of 7 to 10 years. It's going to take a nosedive again. You don't want to always be in that way that you would have worked so hard, but in 7 years or 10 years, there's going to be a recession that's going to wipe out your entire profit. You want to ensure that you're diversifying. For me, multifamily is our major vehicle. I say for many reasons, it has a lot of edge over so many forms of investments. I cannot overemphasize it. This is personal for me. You need to have multifamily real estate as part of your investment. You can't afford not to have it because if you have 401k, go and check it. Or you have stock exchange, go and check it. You will see what I'm saying. But if you're investing in multifamily, come and check what we are doing and compare. But I would like to say this, there is no investment without risk. None, including multifamily. We saw that happening 2 years ago. There was a bloodbath. People were literally foreclosing on multifamily businesses. But the difference between that and this is one can be actually man-made. The multifamily errors or issues that happen most times are literally man-made. When you buy the property wrong or you buy it so high, you don't do your due diligence. You don't manage it well. You have the wrong property manager. Your business plan is not flexible for you to pivot when there's an economy downtime. You're not sensitive enough to know when to exit a market. All these things literally are man-made. So if you're not that experienced, you'll fall prey to all these things, and that will make multifamily be risky. But if you are very experienced and you know how to navigate this entire economy circle, then you are in for an abundance. So that is why I say that multifamily is one of the safest investments that you should have. The next one is secure long-term fixed rate debt. Why some of the deals failed last year in multifamily is because some of them were on floating rate. But if you can secure a fixed rate, then you are in for something good. The next one is increase operational efficiency. I said that before. Your efficiency needs to increase. You need to maintain strong liquidity. So this is not the time for you not to have reserves. This is the time for you to have reserves. And the last, for those of you involved in underwriting, underwrite conservatively. Be very conservative. Like the deal that we currently have on, we actually reduced our projection. Why people are increasing their projection? We deflated our projection. And investors were asking, why did you deflate? I said, because your handwriting is on the wall. You have to be very conservative. So that is what we are trying to do. We're trying to put in measures in case there's a deflation in the market. We are well prepared to handle it. And that is why we did our underwriting in that kind of form and all that. So this is the background. It was a very long background, right? But there's no way I was going to go into question and answers without having to discuss why we are currently having this conversation. It was very important for me to lay the foundation. But I'll go right into some Q&As that I have if no one is asking any question. But if you have questions, please go right ahead and put them in the chat or raise your hand, and we're going to bring you right up to ask your questions. So the first question here is, what makes multifamily more resilient during recession? It's because of the demand for housing. People need a place to live. Demand for housing is consistent. In short, because of what happened in 2017, now there's a lag in construction. That is, the inventory we have, the housing that we have is not enough for the human beings that are being born. The ones that are being born, the ones that are migrating or immigrating from other countries to the US. So now there's high demand for housing. So that is why multifamily is going to be very resilient during recession. The next question I have is, are class A, B, and C properties more recession resistant, and why? So in terms of classes, A is for the cream de la cream, the B is for the middle class income earners, and the C are for the affordable housing. So my answer here is class B and class C would tend to strive more than the class A, and that is why, because the class A might tend to lose their jobs faster. We saw that happen in the tech market. Tech markets were downsizing just a few months ago. Those are the people that earn good monies and all that. And apart from that, AI is replacing some very key roles, some very key jobs. So based on that, class A will feel the brunt more than the B and the C class. The next question is, how do rent growth and occupancy typically respond in a recession? So rent growth typically is flat during recession, but occupancy tends to strive, tends to go up, because regardless of what is going on, there's always going to be a need for housing. What role does cash flow play in recession proving a multifamily asset? Strong cash flow ensures you can cover your debt and also operate your expenses. So in periods like this, you want to look for cash flowing properties that can cover your debt, your mortgage payments, and also give you cash flow whilst we are all waiting for recession to end. So these are some of the questions I have. I don't know if anyone has any question for me before we call it a day. But in summary, recession is very normal to the economic cycle, and multifamily has proven to be recession resilient. And if you're not investing in it, I would advise that you jump right in and start investing in multifamily. And there are different ways for you to invest. You can either invest as a limited partner, that is where maybe you don't have the time, you have the resources to invest, you can decide to do that. And you can also invest as a general partner, that is, you have the sweat equity to put into a deal, and maybe you also have the funds to do that. You can invest in any of those ways. So don't say, I don't know how to invest. There are ways for you to invest. I made a video on who you are, and that video is on our Facebook page right now. And it's important for you to get clarity on who you are, to know exactly where you fall in. Are you a GP or are you an LP? And what are the criteria for both? So you need to figure out what part of that spectrum you belong to, and you start doing your investment. So I would like to wrap up today to say thank you to everyone that took out time to be here. Like I always say, if you are not subscribed to my YouTube page, please go right ahead and do that. We have a lot of content that addresses this type of issues. So please go right ahead and subscribe to our YouTube, which is BB Ofiri, and our Facebook page, which is BB Ofiri, and our Facebook group, which is Blue Ocean Multifamily Group, and Instagram is Blue Ocean_MF Group. My personal handle on Instagram is BB Ofiri. Thank you all for your time, and I look forward to seeing you in our next episode. Thank you all, and have a wonderful day.